the dollar to do this, we're then talking about the world's reserve currency, and the world's reserve currency that prices all commodities. You immediately put all commodities very visibly into a backwardation, which basically means that commodity prices rocket compared with the purchasing power of the dollar. It would be the most disastrous move I think the Fed could ever take. So there's a lot of double counting out there, but we don't really know how much. I think it was Warren Buffett who came up with a lovely phrase that, when the tide goes out, you see what everybody's wearing. And I think that is certainly going to be the situation with the central banks as the gold price rises. The gold price is going to rise. It's quite simple. I mean, they can suppress it as much as they want. That's a short-term effect. But if you're going to accelerate the rate of money printing, bearing in mind that the Lehman crisis created an enormous acceleration of money printing, the one that's coming up is going to be even greater, multiples greater than after the Lehman crisis. You can see that the purchasing power of paper currencies are going to go down, and my personal view is that they will collapse. In other words, fiat currencies will be worth nothing. Now, if that happens, then you could say that the price of gold is infinite, measured in those currencies.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a returning guest. Alasdair Macleod is the head of research at goldmoney.com. He joins us from his home base in the UK. Alasdair, thanks for joining us again this Thursday, May 14th, 2020.
That's my pleasure, DK.
We're circling back with you because of developments of what's happening globally and especially affecting precious metals and those markets. But if we could start with your home there of the UK and its Prime Minister Boris Johnson returning from COVID-19 treatment back into the office and now reopening the country, and what you think is happening regarding that, whether you think that the British economy is likely to rebound quickly, or if there's likely to be protracted effects of the COVID-19 shutdown that we've just finding ourselves going through.
Yeah, sure. As you say, Boris is now out of hospital and back in action. And he's having, in a sense, I think, to pick up some pieces, because one of the things that he really had no option to do was to follow the scientific advice. I think any government minister that doesn't follow the firm advice of his advisors tends to get into deep, deep trouble. So I really don't think there was any alternative. The problem is that the advice was about something for which this country was completely unprepared. I mean, they were meant to do simulations of pandemics back in 2014, but it just hasn't happened. It's always been put on the back burner. So, in a sense, it's the system which has got that bit wrong. So our response was poor, perhaps, to begin with. And then, of course, we had the problem that with this virus, nobody really knew anything about it, and therefore how to respond to it. And quite frankly, when I look at all the information coming out, so much of it is contradictory. But the only thing which seems to stick is take lots of vitamin D. But other than that, really, we are in the dark on this one, and it's very, very difficult. On the other hand, my libertarian friends are appalled at the transfer of personal freedom to the government. Locking down in our homes, the amount of time that we can use our gardens and all this sort of stuff. The police, if you like, arresting people for, being in the parks. But this sort of thing is really, sort of Big Brother, George Orwell type stuff in a way. And so we have all those fears as well. And we do know from experience that when government takes powers to itself from its people, it finds it very difficult to give it back. So this is not a happy situation, and it's a situation where people, I think, are confused. There's a lot of criticism and all the rest of it. And then we come to the economic effects, and the economic effects are dire. There's no two ways about it. You can't just shut down an economy and think, oh, well, we'll just shave a little bit off GDP in our forecast. I'm afraid that is so unrealistic. This is very serious, and the government knows it, and so while they're desperately trying to contain the loss of life from the virus, they are very much aware that the economy is falling apart. The amount of support that the government's having to give to furlough workers, to help the self-employed, to lend extra money to business so that they can stay open, or at least survive the lockdown and then resume. There are lots of very, very optimistic assumptions in this, and it is extremely expensive. And so it seems to me that the outcome, whichever way this pans out in the coming month or two, is not the V-shaped recession. In other words, as soon as we get out of lockdown, everything's going to be fine and we just carry on as normal. I think a more realistic assessment is that there may well be a small recovery in the amount of business for business because, we've done without things. We will have done without things for 1, 2, 3 months, however long it takes. And this means that things like, the things have got to be repaired. We've got to go and buy out the fridge, the freezer that's packed up. The boiler needs servicing because that's packed up, and so on. So you're going to have, if you like, some sort of recovery of business activity in the aftermath of the shutdowns. That is fine, but I don't see it really lasting very long. The problem, as far as industry is concerned, is far deeper than just a return to normal. And don't forget, and this is something that you and I have discussed, don't forget that before the coronavirus shut us all down, the global economy was tipping into a recession, and you may recall that I was forecasting that the combination of a slowdown in the creation of bank credit and a reversal of the creation of bank credit, in other words, a deflationary effect coming from the banks themselves, plus the trade tariffs battle between China and America, the combination was looking very much like what we had in 1929, which led into the Wall Street crash and the Great Depression. There are too many similarities to the background position before the coronavirus even started hitting us to make me absolutely certain, in my own mind, just looking at the at empirical evidence and also economic theory, that this is going to be a prolonged and extremely deep and extremely nasty situation.
Well, thank you for that bright note to start us off here.
Sorry about that. I wish, people. My wife says I'm a pessimist, but I'm not actually. I'm an optimist. But I just have to tell it as it is, or as I see it.
We're glad for that. We have a question here from Ron Acker who says, Alasdair, market futures point to the Fed largely becoming the only buyer of U.S. bonds, so are signaling negative rates. Isn't it correct that with deflation, even if the Fed remains at zero, we actually have negative rates baked in? How long can we possibly continue to buy debt with debt?
Well, the system is broken. And when the system is broken, the only thing we know for sure is at some stage, reality is going to intervene. I don't think it'll be terribly long. I think it is unlikely. I could well turn out to be very wrong, but I think it is unlikely that the Fed will introduce negative interest rates. And the reason I say that is that even though President Trump is saying we should have negative interest rates, I think it's the banks that matter. The banks won't want it. The banks have already got problems with margins being compressed and all the rest of it. Certainly on their quality loans or their low-risk business. And apart from that, really a negative interest rate is a tax on deposits, and it is primarily a tax on the banks, Whether the banks pass it on to deposit holders, of course, is another matter. Negative interest rates are such a stupid thing, particularly for the reserve currency, which prices all our commodities. I mean, it would put the whole commodity complex into backwardation. But having said that, I mean, you know, the hair is running with this story. I mean, I see gold this morning is broken up through a consolidation pattern centered on $1,700, and as we speak, it's $17.35. So I think, you know, gold is certainly telling us that there is a possibility that we will have negative interest rates. I think that gold is telling us that even zero rates are completely ridiculous, and it in effect puts gold into a sort of backwardation. But there are other problems. There are problems in the futures market which exacerbate the situation. But whichever way you look at it, the idea of negative interest rates is completely ridiculous. It hasn't done anything for the Japanese economy or for the EU economy, for that matter.
Right. So if you could help us out there, because we certainly have, it's been going on for some time in both of those areas, perhaps Japan longer. So what is the effects in those areas? What are the effects, and how is it different that you say for the reserve currency being the U.S.? How is that fundamentally something that the U.S. must not do, whereas these other areas of the world have already done it?
Well, I mean, the other countries, like you know, we're talking about Europe. We're talking the EU, that is the ECB's preserve, Swiss National Bank, Bank of Japan. And also the Danish central bank. The Swedish were, I think they've probably gone back to zero, but it just doesn't do anything. The only advantage for the system is to make government borrowing cheap. I mean, if governments are paid to borrow, what's not to like if you're a member of the establishment? It's basically what it boils down to. But for the dollar to do this, I mean, we're then talking about the world's reserve currency, and the world's reserve currency that prices all commodities. You immediately put all commodities very visibly into a backwardation, which basically means that commodity prices rocket compared with the purchasing power of the dollar. It would be the most disastrous move I think the Fed could ever take to, if you like, give in to pressure from the president. The banks, of course, from their point of view, I think, you know, the Fed needs the cooperation of the banks to push all this new inflation, monetary inflation, through to, well, particularly businesses which are suffering payment failures in the supply chains, keep zombie businesses going. Mm-hmm. So, you know, if you're going to push up the prices of commodities, then inevitably what's going to happen is you're going to see the purchasing power of the dollar fall. And when the purchasing power of the dollar falls, think what that's going to do to food prices in America, which are already rising quite rapidly due to the virus shutting down supply chains and so on and so forth. I mean, it would really turn a disaster into a worse disaster. That's all I can say. But anyway, we'll see what they do.
Aside from these effects due to the world reserve currency on commodities, you mentioned that it would put banks in a squeeze. How is that playing out in Japan and in Europe for the banks that are already under those type of negative interest rate policies?
Well, it's a sort of two-way thing, because what it does is it helps the asset side, if you like, of the bank's balance sheets where they have got government debt, because the mark to market, you know, looks all very, very good, but the problem is the margins on their business really sort of fall very significantly. The lower the interest rate, the lower the margin the banks tend to make on their risk-free business or business which is relatively risk-free. The risk business, for example, credit card stuff, you know, they still seem to manage to get away with charging 20 or 30% interest on that. And of course, you know, consumers are relatively they are relatively insensitive to these very high interest rates on their current spending. But other than that, the sort of zero rates are not good. And that the point about a negative interest rate is it is actually a tax on the lender. So, it's the tax. Yes, it's the tax on the lender. So, the banks, in effect, lending money to the central bank or the government, if they are paying for the privilege of doing it, then that is an expense for the banks. There's no other way of describing it. The banks do not like this. They are less organized, I think, in an area like the Eurozone, because you've got many nationalities. You have got local central banks, and the ECB has a habit of ignoring what the national central banks say. But this is very different from America, where the Fed, in effect, does have a very close liaison with the major globally systemically important banks. And I'm pretty sure that the JP Morgans of this world will tell them, don't do it. And it'll be interesting to see who carries greater weight, President Trump or JP Morgan.
We've got some more questions about Eurozone and how this plays out with different countries. Avathor asks, does Alasdair see the world returning to a state of pre-globalism, pre-central bank-induced false economics, where the country's wealth will be more according to their culture and resources, for example, as it was maybe 50 years ago? Does Alasdair think we will return to a split Europe, where the Middle and Western North Europe will be the productive and thus more rich, and Southern European countries return to their more relaxed production, thus less productive and less rich?
I think the two sort of broad questions in there. There's one is a general one of the tide of internationalization being reversed. I think that is probably the case, yes. And it's really because America is increasingly following an isolationist policy, not just with China, but I think generally. Beyond President Trump embracing the idea of a trade deal with the UK, I think a lot of that is basically despite the EU. And I don't see President Trump ever being in favor of EU manufacturers like the German motor industry and so on and so forth, because they take sales and therefore jobs, if you like, from Americans. So I think we've got that sort of protectionism certainly in America. And I think that the geopolitical strategy against China is probably turning China against America as well in terms of business. And it's not really doing an awful lot of good as far as China's relationships with other Western countries are concerned. We have something called the Five Eyes Intelligence Network, which basically means that Britain, Australia, New Zealand, anyway, these sort of global players, as it were, are being pressured very hard by the American intelligence agencies not to do business with China. We've seen this with Huawei in particular. And I think that China has learned the lesson from this, that they're not going to get cooperation, certainly from America. They expected that, I think, in the fullness of time, but also from other countries who are politically aligned with America. And so I think she's probably going to alter her objectives, if you like, on the margin, into being sort of more inward-looking in terms of developing her own economy, and continuing, if you like, with her desire to get Hong Kong more incorporated in her own political system, and also Taiwan. So I'm rather pessimistic on that side. Coming towards Europe, I think I would put the problem slightly differently from the one your correspondent was suggesting, and this is a very recent development, and that is that the German Constitutional Court has decided that it actually has primacy over the European Court. Now, we're going to get a real legal problem on this, but what it does mean is that Germany is not going to go along with the ECB's promised to buy up more and more government debt because they see it undermining the euro. Effectively, it's a transfer of German savings to the Mediterranean nations who tend to be spendthrift. So we are beginning to see, I think, signs of the European dream falling apart. So, but yeah, it's very much a watch this space thing. This situation has started. I can't see quite how it's going to be resolved. And I think that increasing financial strains are probably going to make it even more difficult to resolve.
Yeah.
I mean, normally we would see, a bit of negotiation and all the rest of it, and eventually there's some sort of accommodation made, which both sides can sign up to. I'm having great difficulty seeing how it could possibly go in that direction.
Yeah, we had a question from a different viewer, Steve Mullins, who says, Alasdair, the German Constitutional Court has vetoed Germany from providing euros to the European Union for their COVID-19 bond purchasing compensation scheme. I think it's what you just covered. His question is, could this be a black swan for the upcoming decline of either the euro or the EU, or perhaps both, and how do we think Merkel will respond to this verdict?
Well, I certainly see it as an event which could lead to the end of the European Union, or the fracturing, if you like, of the European Union. I don't think it's something that would happen immediately, but the timing on everything, I think, comes back to what happens to the banks. It's my view that virtually all the banks in the European Union are not only insolvent. I mean, bank insolvency is not something unusual, but definitely bust. I mean, if you look at the relationship between shareholders' capital and the total size of balance sheets, they are horribly geared. I mean, Deutsche Bank is something like 22 times. I think BNP is... UBS is 17 times. No, that's Switzerland. BNP, I can't remember what that is. But even Barclays, we are theoretically still in as far as the European courts are concerned. But even Barclays Bank, British Bank, 22 times. This is far higher bank gearing than you have in America. If we're going to have a banking crisis, and I would have thought that this is almost a certainty, then I think that Europe is the place where it will probably happen.
A lot of eyes have been watching that for some time. People keep pointing fingers at Deutsche Bank as a possible or likely point of failure, but sounds like they're not alone in that.
No, they're not alone. I mean, Commerzbank also, is not too far behind Deutsche Bank in terms of its position. The Italian banks are walking wounded very definitely, and so the French banks. I mean, they cannot afford to take bad debts. Now, what will happen, obviously, is that, if it happens slowly enough, then they can form bad banks and all the rest of it, which basically just hides all the rubbish off balance sheet. It doesn't actually resolve anything. But I think this could actually escalate very, very rapidly. And the reason I think it's going to escalate very rapidly is because of the sheer scale of the money printing that the central banks are going to be embarking upon to save their economies, under the excuse of, well, we must do it because of COVID.
Mm-hmm. Yeah, that's being used as an excuse for a lot of drastic measures of various types. You mentioned the liberty encroachments earlier in your talk. A follow-up question here from the same author. Are there countries on this planet that Alasdair thinks will be able to ride out the reset/storm that we are now entering better than other countries?
That's a very difficult one. I suppose, today, you could say Russia. I don't like to say it, but I think Russia has already sort of cast itself away from the dollar as its principal reserve currency. As it gets dollars in from energy sales, it seems to chuck them out in favor of gold. So that's one. Some of the European countries, funnily enough, if the EU broke, Germany, I think, would probably be all right. That could well if you like, hasten the fracturing of the EU. It would be just a question of national survival rather than these sort of fancy supranational deals in Brussels and Strasbourg and so on. So that's a possibility. Britain is interesting. Britain has always managed to adapt, very often at the very last moment. But we need to think what would be required, I think, to get out of this fiat currency mess. What it would really require, I think, is first of all having gold reserves, and we got rid of most of ours. We seem to show no sign of rebuilding them. The other thing is that you need to rearrange your government involvement in the economy to do away with all the socialization, sort of, if you like, welfare, the commitments to provide this and that and the other thing, which really just becomes so expensive. You need to get government spending to below 20%, in very rough terms, below 20% of GDP, and make sure that it continues in that direction afterwards. Otherwise, you will not get a gold standard to stick for a prolonged period of time. So that's the scale of the mountain that everybody has to climb to get out of this fiat currency situation.
We have several questions from different viewers about the actions of the Federal Reserve or the government in affecting the price of gold bullion. Augie Golfer 66 says, can the Fed cover the losses sustained by the gold bullion banks to keep as much resistance to upwards movement in price, even though they have to keep throwing useless paper at it and never allowing true price discovery?
Well, I think the answer to that is that the Fed has got a printing press and it can print as much as it likes, either in the form of paper money or derivatives which are bought with printed paper money. So it's a difficult question to answer in the sense that really I think what matters is will they do it or won't they? I think they're having difficulty keeping the gold price down now. And the other problem they have got is that the strategic position is that China has the real stuff and everybody else seems to have paper. And the other thing that we don't know is what the central banks actually own in terms of gold. I mean, we know that on paper, that horrible word again, it seems that in Fort Knox and elsewhere, Americans have got 8,133 tons or thereabouts. We don't know what's happened to that because there hasn't been an audit, a proper audit, I think, since about 1954, something, a long, long time. The other problem is that central banks have been leasing their gold to provide liquidity in the London gold system. So how much has been leased, we don't know. The point being that leased gold is effectively double counted because under IMF accounting rules, if a central bank has leased out gold, because the ownership hasn't changed, it can still claim that it's got its gold on the balance sheet, even though it might not get it back. So there's a lot of double counting out there, but we don't really know how much. I think it was Warren Buffett who came up with a lovely phrase that, when the tide goes out, you see what everybody's wearing. And I think that is certainly going to be the situation with the central banks as the gold price rises. The gold price is going to rise. It's quite simple. I mean, they can suppress it as much as they want. That's a short-term effect. But if you're going to accelerate the rate of money printing, bearing in mind that the Lehman crisis created an enormous acceleration of money printing, the one that's coming up is going to be even greater, multiples greater than after the Lehman crisis. You can see that the purchasing power of paper currencies are going to go down, and my personal view is that they will collapse. In other words, fiat currencies will be worth nothing. Now, if that happens, then you could say that the price of gold is infinite, measured in those currencies. You could also say the price of silver, but I think we've had this conversation before. Yeah. Yeah, exactly.
artificially and not according to physical demand what the price is of gold and silver particularly, and one analyst going even as far as to say that it takes a new math or making up of terms that don't really describe what's actually going on to make those claims. Would you like to take the opportunity to clarify and perhaps give some evidence or explanation behind some of the ways that you've described price movements on the metals exchanges and whether they're related to actual commodity contracts towards delivery or if it's just between people trying to move the price?
Well, I think what you're referring to is an article which someone wrote saying that I don't understand commodities well enough to get it, and et cetera. I first became a stockbroker in 1970. I've been a stockbroker, I've been an investment manager, and I've been a director of a bank. So he says there's no such thing as a bullion bank. I mean, on the LBMA, there are 43 banks. COMEX swaps, the number recorded is up to 29 of them, 27 of which were short in mid-February. And you add also to that the 8 largest traders, giving you 35 at least on the COMEX. And the CFT definition, with the COMEX swaps, a swap dealer is an entity that deals primarily in swaps for a commodity and uses the futures markets to manage or hedge the risk associated with those swaps transactions. The swap dealer's counterparties may be speculative traders like hedge funds or traditional commercial clients. Now, that is a description, basically, of what a bullion bank's trading desk does. Come on. No such thing as bullion banks? This is completely wrong. And another thing he said, you cannot have naked short selling in commodities. It cannot exist. What? Look, a bullion bank starts, let's say, with a zero position. His opening position might be to sell 1,000 contracts. He doesn't have to have the contracts to sell in the first place. The message I would give to your viewers is really just be very careful who you listen to. I'm not saying you should listen to me necessarily as opposed to this chap, but just do your due diligence a little bit on the guy's provenance and then make up your mind who to listen to.
Fair enough. Now, we have a couple of questions from viewers that I will perfectly understand if you have to answer in a very general way and with any disclaimers, because neither we nor our guests give personalized or individualized financial advice at all here. That's not what we're here for.
Yep.
We're here for educational purposes. But two of them are asking about, and we'll ask those in principle. Stu Utes says, should I fire sale my commercial property, which have not yet been economically affected but could be? So in other words, what's the outlook for commercial property going forward, and would someone be wise to hedge risk there? Another one, well, let's start with that one, and we'll follow up with the second one.
Yeah. Commercial property, one of the things that's interesting, and I certainly don't give advice on this, and this isn't intended to be advice at all, but the one thing I've noticed here, and I don't know if it's the same in America, but I guess it is that the need to go into the office has actually been sort of blown apart a little bit by the virus. An awful lot of people have worked very effectively from home, and I think will continue to do so. So if that is the case, when we return back to normal, there may be less demand for commercial property than perhaps we thought before this virus hit us. So I think that is an important consideration which may have an effect on prices. I would also draw a distinction, actually, between financial assets and real assets. While in the short term there may be some turbulence for commercial property, I think the real turbulence is likely to be in financial assets. The reason I say this is that the Fed is targeting financial assets to support them as much as possible, because the one thing that it needs to do is to ensure that the U.S. government is funded. The U.S. government cannot afford to pay higher interest rates on its debt. So the Fed needs to suppress interest rates, continue to suppress interest rates, bolster financial asset values, and so on. Now, as long as they achieve that, that's absolutely fine. But history tells us you can only do that for a limited time. And today I'm actually releasing an article on just this subject. pointing out that the last time this happened was 300 years ago in France, when John Law had his scheme. It was the Mississippi Venture, we know it as today, and the whole thing worked on the basis that he printed the money to buy Mississippi Venture shares to get the price up so that he could merge it with his bank, and that was due to happen on the 28th of February, 1720. By December 1719, just a couple of months before, his puffery was beginning to run into trouble, and it sort of just lost momentum. Now, the point is that when the market, as it were, the broader market, understood what was going on and no longer bought the story, not only did the Mississippi shares go down from around about 12,000 livres, which was John Law's printed currency, to around about 1,000 livres, but the currency itself became completely valueless by the September 1720. Now, we face exactly the same conditions today, but on a global scale, which makes this situation, from the point of view of a theoretical economist, so interesting. For the rest of it, it could be a disaster.
Terrifying, yeah.
Yeah, and I'm the point I would like to make is that anyone looking at the prospects for something like commercial property and so on and so forth must also take into consideration what is likely to happen to purely financial assets. If the Fed continues to succeed, etc., wonderful. But if it fails, then John Law-style collapse then becomes the outcome.
This may be a related question based on the risks from the financial aspects. RB asks, should I take out a fixed interest loan to buy more gold? Again, no personal information, but the principle in different environments might lead to that differently. Some guests here have said they're flat out against purchasing assets with borrowed money. Others haven't. But your thoughts in this current environment on someone who's contemplating, and of course we don't know their situation, but just the principles around that.
Yeah, sure. It's an interesting one, because if we have the sort of currency collapse I'm talking about, then basically anyone who owes money in a collapsed currency, in effect, has bought what he bought in that collapsed currency for nothing. And that, of course, is the attraction, if you like, of borrowing fiat in order to buy gold. There was a situation in 1922-23. There was a chap called Hugo Stinnes who became known as the inflation king in Germany at that time. If you may recall, there was a hyperinflation, which really took off in about May 1923. And he bought up something like a quarter of all the productive economy. The interesting thing was he avoided financial assets, but what he did was he borrowed money to buy real assets. He bought factories, estates, other property, and so on and so forth, borrowing worthless marks or marks that turned out to be worthless shortly afterwards. And that, in a sense, is a difficult one, because if you've got sort of some sense of morality, then really what you're doing is you're stealing stuff off people who are in a position of real distress and benefiting from it. Not everybody can really do that, I think. It's a thing that you'd have to sort of think about quite carefully if you were going to go down that route. And the sad thing, as far as Stinnes was concerned, was that he actually died of a gallbladder operation in 1924, so he didn't actually enjoy that position of being the inflation king for terribly long. Anyway, I've given you some information to digest, as always, I suspect that the sensible thing is just don't try to be too clever.
There's a lot of questions here, and I'm going to merge them into one behind this one from Anubis 8000, who says, Alasdair, please describe the picture you have in your head for weekly life after gold and silver have reached and reset to their true value. Please describe this for those that have and those that have not.
Well, if you have it, then you can buy things. You can do two things. I mean, the whole point of having physical gold is that you will spend it at the end of the day, and the purchasing power of the physical gold will rise simply because of the distress, if you like, that comes about from the collapse of fiat currencies. So you will be in a very strong position if you do have that. But remember that it's not a question of saying, well, I can go out and buy a fancy yacht or I can go out and buy a new estate. I mean, there was in Germany, $100 could buy you 6-story townhouses, a street of them, in Berlin in 1923. So, you can have an awful lot of benefit from having gold. But remember that we exist as a society, and you will have relatives and friends and all the rest of it who would otherwise be starving because they certainly won't have gold. And I think that what I have in mind for myself is that I will need to support my family. That's going to be the first, the most important thing in those conditions. If there's anything over from there, then I think that I need to help my local community. So there's going to have to be that sort of charitable support, and that's going to be an expense. And I would be prepared to make that expense if the worst happens. If you haven't got it, if you haven't got gold or silver, then I'm afraid that without any money, you're going to have to try and earn it somehow. And in a situation where governments are trying to sort of support people, discouraging them, if you like, from going out to work or to think of doing other things, it really does mean that any depression, which is what we're talking about, and it's the ultimate depression, will be really pretty long-lasting because the government will do its damnedest to interfere. If it didn't interfere, then things would probably right themselves quite quickly. Gold would get into circulation because it would be spent into circulation by people like me, and we would probably have a year or 18 months at most of a real depression. But when governments start interfering, it'll go on and on and on. It'd be just like the 1930s, the New Deal preceded by Hoover.
Well, Alasdair, we're grateful for your presence here with us today. People, thanks for bearing with us that we had technical difficulties on the heavily burdened internet circuit, so we had to go with voice only for today. But remind people where they can reach you on and see more of your work, Alasdair.
Yes, sure. Goldmoney.com, and if you look at the menu, you'll find that there's a research section, and in there, Insights, I publish one every Thursday, which happens to be today. This is being recorded. And I do a market report on the Fridays, so that will be tomorrow, compared with the day that this is recorded. So that's where most of my writing is, and I hope you find it useful.
Very well. Alasdair, thank you for joining us this time again here on Liberty Finance and Reluctant Preppers.
My pleasure, DK.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.